Hello, it's John, and this week I'd like to talk to you a bit about growing your business. We've got to the beginning of a new year, and this is a time when a lot of people like to take a moment to reflect on where they've been and make some plans about where they're going. And accounts can be really useful for this. So I thought I'd talk you through some of the things that I would be doing if I was looking at a set of accounts to work out where I am and where I'm going. The first thing that I'd be choosing is a few really important numbers that will make a difference to my business. I'll give you an example. Sales. Sales is a pretty obvious one, right? But if a business doesn't have sales coming in most cases, it's not going to be performing the way that its owners want it to. So if I were sitting down to look at my business and consider how it's done over the last year, I'd probably look at my turnover number and say, is this where I want it to be? How's it looking? The next thing I would be doing is thinking, what do I want it to be next year? So, Katie, this is a note for you when you're editing it, but if you'd remove the next thing is looking at where I want it to be, I'm going to start again from there. The next thing that I would be doing is comparing it to something. Having a number, for example, turnover for last year is a fantastic tool to use for your business. You can say, here's my turnover, but is it what I wanted it to be? It's much easier to decide whether a number is what you want it to be if you have something to compare it to. So, for example, some people will look at their turnover for last year and say, how does that compare to the year before? Other people will have their turnover for the year and they will think, how does this compare to the targets that I set myself at this time last year? And if you did that, fantastic, because there's nothing better than having a target that you can aim for. If you didn't and you're looking at your turnover for the first time and thinking, is this where I want it to be? Then why not start now by setting a target for the new year? What do you want to achieve? Hopefully that all seems pretty basic to you, but I can't stress enough the importance and also the benefit that can come from reviewing where you've been with a number, comparing it to something, and then planning where you'd like to go next. Once you've got that target in mind, your mind can't help but to turn to how am I going to achieve it? What do I need to do to get there? So that's the basics. Choose a number, compare it to something, decide what you want to do next. I thought I'd spend a minute just running through some of the other key performance indicators. That's what we call them. Key performance indicators are the key numbers that can make a difference to the performance of your business. So let's look at a few of them that could make a big difference if you start looking at them, if you start considering, how am I doing in comparison to where I want to be? We've talked about sales. Sales is an amazing one, but sales is not everything. There's rhetoric, for example, turnover is vanity and profit is sanity. So what about profit? Maybe we need to look at the profit line as well. There's all sorts of different types of profit, but if you're looking at any of them, it's much better than looking at none of them. The most basic form of profit would be net profit. This is where you take all of your costs and look at how much money is left after all of your costs. You will see some people use different profits though. For example, gross profit. Gross profit is a great one if you are making something because you can take your sales and only deduct the cost of making that item. For example, if you're making a cake, you could look at how much you sold the cake for. You could look at the cost of making the cake. You take that off and you get your gross profit. Gross profit is a nice one because you can divide gross profit by your sales to get a gross profit margin. And that tells you how much of your sales end up in your pocket for you to spend on the business. I'll take an example of hospitality. In a lot of hospitality businesses, they'll be aiming for their food cost to be about 25-30% of their sales. If they manage to get that, 25-30%, let's say 30%, it means that their gross profit will be 70% of their sales. You can use that then to say, well, let's do the same as we did with turnover. What was my gross profit last year? How does that compare to what I'd like it to be? You might compare it to the year before and say, is my gross profit higher or lower? If your gross profit is lower, either your sales aren't as high or your food cost has gone up, maybe. Or you might say, how does this compare to the industry average? And for a lot of industries, there is a well-known or well-determined, established gross profit margin. If you don't know the gross profit margin for your industry, then do get in touch with us, because we've got access to a whole load of data on what we would expect to see from a business such as yours. So get in touch and ask. It will give you a benchmark you can use to compare your performance against the performance that would be expected in your industry. If you find yours is different, we can start asking the question why, and then move on to what do you want next year? And that's the key question. What do you want? What's your target? Looking at other profit metrics, there's another one you might have heard about, which is EBITDA. And I think that's probably worth a video all on its own, because it's so useful for people who are looking to grow their business or sell their business. It's also useful for saying, okay, how much of my profit is going to turn into cash? Because profit is sales minus all your expenses. And in a set of accounts, you have cash expenses. For example, if you went to the shops and purchased something, that's an expense. But there's also things like depreciation. Well, you don't spend depreciation, it's an accounting adjustment. And there's plenty of other accounting adjustments and other things like that. Some businesses find it very useful to sort of disregard those and work out their EBITDA, which is earnings before interest, tax, depreciation, and amortization. This profit metric shows you kind of how much money is going to be in the business. It's not as simple as that, but it is a very useful one for certain businesses. Like I say, it's worth a video all on its own, but it might be worth calculating that one. There's then some other key performance indicators that are useful for businesses that are maybe, oh dear, let's start that again. There's then some other key performance indicators you might find useful too. Here are some examples. If staff cost is a big part of your business, maybe you want to look at what was my staff bill compared to my turnover. And if you take your total wages cost and divide that by your total sales, you can see how much of your sales income went on staff. Again, this is really useful in hospitality. There are well-defined expectations as to how much it should cost in manpower to run a restaurant. And so you can calculate what yours is and see whether it's getting better or worse. If you're spending too much on staff, it won't leave enough money for you to run the rest of the business. So it's a really great one to keep an eye on. It's not just profit and sales key performance indicators that are worth looking at though. There are others to do with how you're operating the business that are great to look at. One example is debtors, customers, and how much money they owe you. You can look at how much your customers owe. And you might look at it and say, my customers owe me 200,000 this month, or at the end of my year. You could then look at the previous year and let's say it was 100,000. You could say, oh, well, they owe me a lot more now. That could be a couple of things, of course. It could be that you've sold a whole load more, that your business has doubled in size. Or it could be that you are not collecting money from your customers as well as you used to. There's a great KPI to look at this. It's called debtor days. Debtor days is where you take your debtors figure, you divide it by your sales, you times it by the length of the period, and you can work out how many days it's taking your customers to pay you on average. And this is super useful because it strips out that growth problem. If your business has grown, if it's doubled, let's say your debtors has doubled and your sales has doubled, well, when you divide one by the other, you're going to get the same number. And so it's a really useful way of seeing, okay, even though my business has grown, how is my performance at collecting debt compared to a year ago? Remember, this is really important because if you collect money from your customers, you will have money in your bank. But if you let that slip, even if you've got a great sales total, a great profit margin, if it's sat in your customer's bank instead of yours, well, I would say that your performance is not quite as great as you'd like it to be. That's debtor days, really worth looking at. Another one that will impact the cash in your business is to do with stock holding. And we can do the same thing. We can look at the amount of stock that you're holding, and we can compare that to the amount of purchases you've made. Divide one by the other, and you can start to work out how many days of stock I have on hand. Let's say, for example, that your stock holding was £100,000 and your purchases every month were £50,000. That would say to me that you have enough in stock for the next 2 months of production, because you've got 100,000 in stock, but you only need 50,000 to run your business for the next month. Well, look at this one. And if this is getting worse, it implies that you're holding stock that maybe you didn't need to buy just yet. This means that you're tying up cash, and there'll be basically money sat in your warehouse doing nothing, whereas it could have been cash in your bank. Let's finish with a pretty straightforward one that anyone can do by looking at their accounts. It's called net assets. You can look at the net assets of your business. This will show on your balance sheet, and it's the final number. And you can see whether it's bigger or smaller than last year. If your net assets are going up, that's a good thing. It means that your business has made profit and that money has stayed in the business. Now, I'm oversimplifying things by saying it's a good thing. There are certain businesses which might find that their net assets are going up too high, and we might be having a conversation with those guys about how are you going to get that money out of your company without paying a whole lot of tax. If this is you, please do get in touch. But equally, if you're looking at your net assets and it isn't where you want it to be, talk to us as well, because we can probably help you find those key performance indicators for your business that will help you make the difference to the targets you set for the new year, and hopefully therefore make a difference to the performance and profit you can make in the year to come. I'll finish by wishing you all a very happy new year. If anything here has caught your interest and you'd like to find out more about it, please do get in touch. We'd be incredibly happy to talk you through it in more detail.